So welcome to our webinar on compounding quality. This is your guide to unleashing the power of quality investing. My name is Megan Boxall, and for any of you who haven't attended one of our webinars before, hopefully the system's all relatively straightforward. I can see lots of you already joining in the chat box, so that's great. Please use that to ask any questions. We're joined today by Lawrence Judd, as always. He'll be moderating that chat section. So he can he'll try and answer any questions that he can in the chat, but he'll also flag some to me. So we'll come back to those at the end of the presentation, which will probably last about 40 minutes, and then we'll have time at the end to fit the questions. First up, just a little disclaimer. Obviously, as ever, this isn't investment advice. Stocks can go down as well as they can go up, and always remember to do your own research. Luckily today, with the topic being quality investing, doing your own research can be great fun. I personally love researching quality companies, hunting for stocks which are truly the best in the world. So what is a quality stock? It's they're market leaders. They tend to generate very strong profits and even stronger cash flow. And crucially, they reinvest that cash into new ventures, whether that be acquisitions or R&D. And it's that reinvestment that's key, and what helps them grow and compound away. And it's that compounding quality, that really, really true quality that we're going to be really focusing on today. So what's coming up? Firstly, why the quality investment strategy works in turbulent markets. Hopefully there'll be lots that's interesting in there for you in the current market climate. Secondly, what are the metrics and what qualities are there that make that quality company? To do that, we're going to be taking a closer look at the investment case of one of my favorite stocks. And then we are going to talk about the screens that we need to use to identify those quality companies, and other ways that we can drill into what a truly quality company is. And then we will talk about the mindset. The mindset's quite an important part of what we're discussing here today. The mindset that is required to be a successful quality investor. So as I say, presentation about 40 minutes, and then we'll follow by questions. And thank you to anyone who submitted questions ahead of time. It's given me a nice chance to prepare. But first of all, as this is my first webinar for Stockopedia, I thought I'd introduce myself, talk briefly about my own investing mindset and where it has come from. I've grown up in a house where Warren Buffett is very much revered. I have certainly inherited a love of quality investing, engaging with management, gaining a really deep understanding. These books that you can see on the left here and this mug are actually my dad's. At Investors Champion, where I worked during university and for a brief time afterwards, I followed my dad's lead. Investors Champion is a part of a small asset management firm. And the research that I was doing there was really about getting to know the companies as closely as possible, engaging with management, gaining a really deep understanding. The asset management firm that Investors Champion is part of it specializes in AIM and small caps. So that was a great place to enter the world of investing for the first time. After I left university in 2014, I joined the Investors Chronicle as a journalist, and it was there actually that I was presented with a copy of the Zulu Principle, which was my first real experience of stock screening. Algie Hall, he sat next to me at the time, and he was obviously a strong advocate. It was him who gave me the Zulu Principle and was, you have to read this, and strong advocate for the use of screening. And in the years working with him, he really helped nurture that mindset, which has obviously been extremely useful at Stockopedia. I was at the IC for 3 years before I headed back to join my dad at Investors Champion to build out that website and try and help investors of all different abilities. And I built a few model portfolios there, which is still going strong. And then at the start of last year, I joined Stockopedia. Hopefully some of you have been able to read some of my articles and contributions to the community. Now, before we go on to talk about the quality investment strategy in detail, I thought it was worth providing a bit of background to the thinking behind this webinar and the series of content that it's part of. As some of you on the call right now will know, at Stockopedia, we use 3 of the core stock market drivers to rank all the stocks across all the markets. And these drivers are quality, value, and momentum. And the ranking is based on years of literature which show that these core drivers or factors make a significant contribution to stock market returns. Now, using this model, we've created a framework which aims to help investors map their investment mindset to one of each of these factors. So in brief, the map, as we can see, is a Venn diagram made up of those three: quality, value, and momentum factors. So the first one, which we're going to be talking about today, is compounding quality, pure quality. And it's the principle behind the style used by investors like Terry Smith and Warren Buffett, they seek to invest in the best companies of all time. And these companies, as I said before, reinvest their profits at a high rate of return, compounding their growth. So the deep value strategy, which you can see in the green there, has a slightly different mindset. It has been very successful to investors like Ben Graham in the past, and they've profited from stocks which are priced significantly cheaper than their true intrinsic value. In deep value is something that I would hold my hands up to not being very good at, because my mindset just isn't quite right. Similarly with breakout momentum, these stocks benefit from share price momentum on the upside. Again, a different kind of mindset required to really thrive in that kind of market strategy. So as you can see, we've drawn the quality, value, momentum circles on the Venn diagram, and at the intersections there are three more styles which rely on two of the factors each. And in the center is the combined strategy, which leans on all three of the market drivers. Now, there has been plenty of literature which shows that all of the three factors and the multi-factor strategies work. And in this slide, we've shown you some of the books which famous investors who have used these strategies and how they've done so effectively. And as I said, these slides will be available for you to download at the end of the session. So if you want to look at this slide in more detail and get some ideas of the books that we recommend, that'll be available afterwards. But as I say, what we're really trying to achieve with this series of content and this webinar today is help investors understand the mindset and the time frame which suits the various strategies. For example, the deep value strategy suits medium to long-term investors who are willing to be brave. I've recently written about the fact that I really struggle with that mindset. The breakout momentum suits really ruthless investors with a short term, 3 months to a year is how that factor really works. And then compounding quality, which we're going to talk about today, that is really suited to patient investors with that long-term time horizon who can have the discipline to wait for the returns to compound over time. Now, it is worth being clear at this stage that not all the strategies work brilliantly in all the markets, being careful not to be too enthusiastic about all the strategies, especially in the current market conditions. But good news for right now is that the quality factor does tend to work in turbulent markets. Now, we're going to look at that in a bit more detail. So breaking down the next few slides, we're breaking down the different stages of an economic cycle. So starting off with that recovery phase, so where are we right now is hard to tell, but let's imagine a recovery phase for a while, that bouncing back from a market bottom. And it's there that the value factor really thrives, the really down and out stocks that have been priced well below their intrinsic value. And value is an extremely successful market driver during that period. So next up, we have an expansion phase of the market cycle. So after the recovery, the stocks are growing, stocks are thriving. And it's at the top of those periods that momentum can be a really strong factor. So the shares that are growing, they just keep growing. And then moving on to the quality, where quality thrives, and that's in the slowdown, and actually as well in a contraction of the economic cycle. Now, that's not to say that quality performs badly during other phases. There can still be growth in quality stocks during a recovery and expansion phases, and indeed there normally is. But it's just that factor doesn't perform quite as well as the other factors. Whereas during a market downturn, it actually performs a lot better. So we can see that in this bar chart. This data was collected across global markets between 1989 and 2021. And it focuses on the performances of the stocks which are ranked the highest for 4 different individual quality metrics. So that's net profit margin, earnings growth stability, return on equity, and low debt. So in the dark blue bars, we can see how those stocks, which are the highest ranked according to the quality metrics, how those stocks perform during periods of market weakness. So just running through those different metrics. So the companies with the highest net profit, they outperformed the market during those down periods by over 8%. That's the earnings growth stability. Sorry, the net profit margins outperformed by about 5%. The return on equity was just under 5%. Low debt, less of a firm, less of a solid performance, but it still did outperform during those down periods. That's companies with low debt. And yeah, as I said, the companies with the highest growth stability outperformed by over 8%. But more significantly, if we look at the bar on the right, I'm sorry, my little image is covering up just that bottom bit. But what that is what this far right bar is the quality composite. So that is the composite of all four of those metrics. So the stocks that are ranked the highest for the quality composite outperform the market during these down periods by almost 9%, so more than the stocks that are top ranked for all the individual elements. And that's interesting because it shows the combination of multiple quality metrics created the strongest performance. And it's a phenomenon that we've also seen in our Stockopedia data. Now, by contrast, we can see in the light blue bars that these highest quality stocks have lagged the markets during the most extreme upcycle. So here, the most extreme upcycle, they were taken at the peak of the dot-com boom and in 2003, shortly after the dot-com bust, in the bounce back from the 2008 financial crisis, and also after the COVID collapse. So those were the strongest upcycles. But just because these light blue bars are showing that the quality ranks underperform the market, it doesn't mean that they weren't growing. So should this chart deter you from picking quality stocks and holding them for the long term through different stages of the market cycle, good or bad? We'll be talking about holding periods in a little while. But for now, we're going to drill down into why quality companies are resilient during troubled markets. Now, to answer that question, we're going to have a look at what makes a quality stock and why those qualities help support these companies during challenging economic times. And to do that, we're going to look at my favorite company. It's my favorite company regardless of its valuation, but if valuation, which we'll come on to talk about in a little bit, is something that worries you, this is an expensive stock. It normally is an expensive stock. It is the US tech company Adobe. In this video, we're going to show you how to use Stockopedia's tools to identify quality companies, using US tech giant Adobe, a truly quality company, as an example. First, a bit of history. Founded in 1982, Adobe was a classic Silicon Valley story, founded out of the garage of a super intelligent tech wizard. Within a year, Steve Jobs had attempted to buy the company, but the founders refused, and instead set up a deal with Apple, licensing the PostScript product. The license gave Adobe a very different start to many Silicon Valley startups, and within its first year was making profits, which were reinvested into new ventures, and by 1985 the company had also launched Illustrator and Photoshop. Revenues came in very quickly. You can see from this chart the way Adobe's licenses made high profits, which the company then reinvested into new ventures. In 1995, Adobe launched the portable document format, PDF, and continued to innovate with new features for the Photoshop product. Fast forward a few years and the way people use computers has changed. By 2012, with the proliferation of the internet and the advent of the cloud, people don't have to buy long-term licenses to have access to software. They can sign up for subscriptions. And so, Adobe has changed its business model. You can see in the results from 2011 to 2015, when the company made the transition from a licensing business to a subscription business, that revenue and profits were impacted. But in the long run, that decision was very sensible, as we can see as we dig into Adobe's stock report. Let's take a look at the numbers in the stock report now. First, there's the revenue, which has risen from $7.3 billion to $17.6 billion in the last 5 years. That's a compound annual growth rate of 19%. The next line down, we can see operating profits have risen even faster in that time. And scrolling down to here, we can see that it's thanks to a widening operating margin, which have averaged 32.5% over the last 5 years. In this cash flow section, we can also see that Adobe's operating and free cash flow generation has been incredibly impressive. The company actually converts well over 120% of its operating profits into cash every year. And crucially, as cash inflows have risen, so has capital expenditure, showing that the company has a good attitude to reinvesting its cash profits. An important metric for assessing quality is return on capital employed, or ROCE. ROCE at Adobe has risen from 19.8% in 2017 to 32% in the last set of results. If we click on the ROCE metric here, we can see what that means and how we have calculated it. And right down here, we can capture a snapshot of the balance sheet health. It shows a net debt figure which is negative, which means Adobe is in a net cash position, and has been for every one of the last 5 years. Returning to our overall picture of Adobe, there are many hallmarks which we're looking for in a quality company. A unique product or service which is almost impossible to replicate and is relied upon by dedicated customers. A highly profitable business model which churns off high margins and plenty of cash. A positive attitude to reinvesting the cash into the business, and reinvestment plans which don't rely on excessive borrowing, which can become expensive. And high returns from that investment, shown by a strong return on capital employed. So that's Adobe and the quality metrics. But why does all of that help during periods of turbulence? So the first thing is defensiveness. So many quality companies make products or services which are essentials rather than luxuries, and during downturns in an economic cycle, those are still in high demand. Second thing is pricing power. So with those high barriers to entry, these companies have very strong pricing power, which means they can increase their prices during inflationary times, and customers will still be willing to pay. And in addition to the fact that these companies won't be losing customers, it also means that they can up prices to combat a rise in raw materials, so protecting margins. And finally, lower leverage. So companies with high leverage are more exposed to changes in the economic cycle because they have to pay interest on their debt, which becomes more expensive in a higher interest rate environment. But high quality companies tend to rely less on debt. Not to say that they don't have any debt at all, but they rely less on that debt to continue growing. So then back to the question of time frame. If the quality strategy underperforms other strategies during different parts of the market cycle, should you favour other strategies during those times? And the very short answer is no. The quality compounding strategy works best over the long run. So you shouldn't be tempted to sell your quality stocks just because of what the wider market is doing. But that said, some investors like to add other strategies during these different stages. You might want to hold some cash back to deploy when value is in its element or momentum is soaring, so for example. And in this chart, we can see the impact of holding those stocks for the long term by looking at companies with a high return on capital employed. So as you saw briefly in that video, return on capital employed is an important metric for identifying high quality companies. And for me, it is my favorite metric for really identifying what a highly quality company is. So return on capital employed is, put very, very briefly, is the amount of profits which are generated from the investment made in the business. So for every pound invested, what percentage, what P is generated from that investment. So let's say a company invests £1. If it has a return on capital employed of 20%, they'll make 20p. So the higher that return on capital employed, the more profitable, the higher quality that business is. In this chart shows that over the last 10 years, stock with the stocks with the highest return on capital employed, or ROCE rank, have risen by 146%, which is roughly an annualized return of 12%. And we can see in the orange line how that compares to pretty uninspiring performance from the FTSE. Have been blips along the way in that time, but overall, the highest quality stocks shown by that high ROCE have generated extremely impressive returns. So interestingly, we've also got data which shows that pure high quality stocks have outperformed those which also exhibit strong value metrics. So this chart shows the returns of the highest ROCE companies, which also have a price to earnings ratio of less than 20 times. And it shows that these companies have returned about 77% over the last decade compared to 146% from the pure ROCE stocks. Now, it is important to put that into context because quality investing isn't always easy. And that value point is particularly important. It's especially a pesky one because quality stocks rarely trade on attractive valuation multiples. So the principles of value investing, which is buy stocks which are currently priced below the company's intrinsic value, that makes a lot of sense. So paying high multiples for companies can feel like a very counterintuitive thing to do. So even some of the most revered quality investors like Terry Smith and Warren Buffett, they caveat their quest for quality by saying don't overpay. Right now, that is a bit of a challenge because high quality stocks trade on high multiples. In the UK, the 20 stocks with the highest return on capital employed have an average price to earnings ratio of 18 compared to a market average of 13.4. And the situation is even worse in the US, where the highest ROCE stocks have an average PE of 26 times compared to about 23 for the market average. So to overcome these issues, it's important to think about mindset and whether you have the patience to be a quality investor. So you have to be okay with buying stocks on high valuation multiples. That's not to say being reckless with it, but just being comfortable with valuation multiples which may be a little bit stretched. It's also important to have a long-term time horizon to, as we've seen in those charts, to truly enjoy the benefits of compounding. You need to be in it for the long run because it's the compounding, it's the reinvestment and the growth which is really how you benefit from the compounding quality strategy. And you also have to be okay with those periods of turbulence where other stocks might be doing better, other stocks which are driven by other factors. So the discipline and the patience and the diligence to do your own research and be comfortable with the stocks you're holding, no matter what's happening in the wider market, are really key. So next up, we're going to talk about how you identify those companies. So some people like to scour the whole market, maybe look at specific sectors which they are most familiar with, which I think they think are the most attractive. For me, the very first step is to whittle down the investment universe a bit with a screen. And this video, which I'm just going to share with you now, will show you how to do that on Stockopedia. Very few investors would turn up their noses at an opportunity to pick stocks like Warren Buffett. In the 56 years since he set up his investment firm, Berkshire Hathaway, its share price has risen by more than 3 million%. But Warren Buffett's criteria for investment success is no secret. The performance is testament to his mantra of buying great companies which can reinvest their earnings profitably over long periods of time. In this video, we'll show you how to use Stockopedia's tools to build a screen to help you identify Buffett stocks. First up, head to the sidebar and click New Screen. You can choose to give your screen a name now or leave it until later if you'd rather. I'm going to name it now so it doesn't get lost. Warren Buffett screen. And now on to the rules. Stockopedia has many hundreds of rules in its screener, and you can either explore them by browsing through the lists here or by typing specific metrics. First of all, we're going to whittle down our investment universe a bit by screening out companies of a certain size and in certain sectors. These days, Buffett tends to pick larger stocks. His firm is so big that he has to. But private investors can benefit from their ability to invest in smaller companies. But I do want to remove the smallest and riskiest stocks in the market, so I'm going to screen for companies with a market capitalisation greater than £50 million. Buffett also often talks about the importance of being able to understand all businesses he invests in. And so for this screen, we've opted to exclude metals and mining, coal, and investment banking and investment services. If you're building your own Buffett screen, you can alter the sector choices to suit your own preference. Next, we'll look at one of Buffett's key requirements, businesses with above average profitability. Now, we've got a few options here for showing companies with a high return on capital, but the one we're going to pick is this return on capital as defined by another reputable US investor, Joel Greenblatt. The reason for picking this definition is because it more closely calculates the profit a company earns from its operations and fixed assets, which aligns with Warren Buffett's thinking. But you can choose a different metric for returns, return on capital employed or return on invested capital perhaps, if you're more familiar with them. Regardless, we're looking for high returns over the long term, so we'll specify a 5-year average and limit our companies to a 5-year return on capital of above 15%. For further assurance that we're selecting highly profitable companies, we're going to add a return on equity screen to ensure we're only selecting companies which are generating decent profits from the investments made by their shareholders. Again, we're looking for a 5-year average of more than 15%. But it's not just equity that we want to make sure that the company is using effectively. We also want to ensure we're picking companies that fund future growth using their own profits. Estimating a company's ability to grow in the future is difficult, but our tools can help you replicate Buffett's talent for identifying growing companies. Using the work of Warren Buffett's former daughter-in-law, we've created an expected return rule, which you can find by scrolling right to the bottom of the growth section of the screening tools. You want to make sure you have selected sustainable growth, and then in this screen we've specified a minimum expected growth of 6%. To complement this, we've also used another rule to demonstrate a growth trend. 5-year compound annual earnings growth per share of at least 5%. Fourth, we acknowledge that Warren Buffett dislikes companies that rely on debt to generate growth. To avoid these stocks, we screened for companies with a net gearing of less than 60%. We've opted to use the net gearing including pensions figure. The reasons being that if we use a gearing figure based on total liabilities, we might exclude a few too many companies. Remember that screening results are always a starting point for further investigation, not a final selection. And finally, valuation. Now, for pure quality investors, valuation is of less importance. And returning to our Buffett quote at the beginning, it's better to buy a great company at a fair price than a fair company at a great price. The question, though, is what is a fair price? Buffett and many other quality investors look for companies which have a market valuation below their intrinsic value, and to identify these we've opted for 2 ratios. First, an earnings yield, which shows how much a company earns compared to its total market capitalization plus debt, otherwise known as enterprise value. We're looking for stocks with an earnings yield greater than 6%. And then enterprise value to free cash flow ratio, which looks at a company's ability to generate cash. Put plainly, the lower the ratio, the faster a company can generate cash to reinvest in its business. So here we're looking for a ratio of less than 25 times. So there we have it, the finished screen, providing a list of stocks which Warren Buffett might consider for his portfolio at Berkshire Hathaway. You can see from this screen that I've selected all international markets, so we might want to whittle this down further to only select stocks from certain more accessible markets. Just go back into your screen editing and add a criteria which allows you to see just stocks from only a handful of countries. Perhaps you just want to look for stocks in the UK. Or maybe you're feeling a bit more adventurous and you want to have a look for stocks in the US. And you can always play around with the rules of your screen. If you're not as focused on the value factor, you could always remove those metrics. But remember, this is just a starting point. Although we have whittled down the number of stocks to a manageable length, it's worth doing a bit more research on any promising companies before committing. So that's our Warren Buffett screen. Just at this point, I want to give a shout out to Roland Head, who put that screen together. It is available online in written form as well. So, and we'll share the link with you for that at the end of the after the webinar, so you can have a look at the stocks which are currently popping up on that screen. It is a good one. But yeah, that's our starting point for whittling down that long list. Obviously, there was still quite a lot of stocks on there, but it's a smaller investment universe than looking at the entire market, and we can be assured that we are only looking at stocks which are hitting all of our metrics for quality. So from that long list, it is then time to take a deeper look at some of the more interesting stocks. And I am now going to take a look at the French luxury goods company LVMH, which emerged from that quality screen. So my first step is normally to take a look at the financial statements. And that's not just the most recent ones. It is good to go back and have a look at historic annual reports. And here, Stockopedia's stock report can really help. I'm really looking for changes in the trends. Have there been any years where sales growth has stumbled or operating profit has fallen out of whack? So we can see here that in 2020, LVMH did suffer. Earnings growth was down, revenue growth was significantly down, but there was a valid explanation. That was the year that most of the world went into lockdown, so people weren't buying luxury goods. But I mean, over the last 5 years, as we can see, the growth at LVMH has really been quite spectacular. It's also good to take a look at the balance sheet just to check for anything dodgy, a big increase in debt or a shift in working capital, anything that might suggest that there's something not quite right at the business. And then there are the non-financial aspects. Firstly, how does a company make money? So it's really important, and this is actually something that Warren Buffett says a lot as well, to understand the companies that you're investing in. In the case of LVMH, it's a relatively simple business model. It sells luxury goods, lots of different brands of it, all over the world. But it's always, and I always find it's really essential to really understand the sector that you're investing in and the actual business. For me, that means I do tend to steer clear of resources companies. I don't particularly like mining businesses because I'm not very familiar with them. And while I'm sure there are some excellent returns, obviously last year the energy sector was thriving. For me, it wasn't something that I was comfortable investing in. So I just sort of stayed away from it. The second thing that's really important to look at is the management situation. Does the board and the CEO, do they have a good track record of decision making? So again, at LVMH, it's quite easy to assess this situation because Bernard Arnault, the founder and the CEO, he's very high profile. He regularly gives interviews and he appears all over the media. So for some smaller companies, gaining an understanding of the business model and management can be a bit tricky. Some investors really like to try and meet the companies they invest in, or at the very least attend presentations and AGMs. And actually in recent years with events like Mello and the platform Investor Meets Company, where management can give updates around their financial results, it has become a lot easier for private investors to get that face-to-face time with management of small companies in particular. And it's well worth attending those if you can. But it is worth noting that management can spin a good story. So try and do your research before you speak to management, so you're not being swayed by an attractive narrative. And then the final thing, which I want to pick up on, is the importance of a protective moat. So this is another non-financial quality, which is pretty crucial to quality compounders. So much so that it gets its own slide. So the economic moat is a term given when a business has a protected advantage over its peers in the same market. So that might be something like a strong or recognizable brand, like in the case of LVMH or Nike. But there are other things which can be considered a protective moat as well. So a really good example is, going back to our example from earlier on, Adobe. Adobe creates a lot of software which is used by designers, and designers are used to that software. They don't necessarily want to switch or learn how to use other software. So the switching cost for Adobe's customers is so high that they are very, very sticky customers, and they can be really relied upon to keep paying their subscription every single year. Another really key example of a protective moat, and one that's been a hot topic in the last few years, is a network effect. It's been a hot topic because the network effect has been massive for companies like Google and for Facebook. There are also economies of scale which can create a protective moat. Companies like the example I've given here, like Boeing. Boeing is an enormous airline company. It's extremely difficult to set up an airline company. So the fact that some of the larger companies in the sector have gained that size, it makes it very hard for newcomers to compete. And finally, there are legal advantages, patents and trademarks, often seen in pharmaceutical companies, but also some areas of tech. Now, an example of a protective moat, which is really key and really interesting, is actually Apple. And the reason it's really interesting is because it really shows how difficult it is to assess that protective moat. So Apple's protective moat, it has lots, and a lot of companies, a lot of high quality companies do have lots of different things that protect it. But one of Apple's really key protective qualities is what is called its walled garden. So where customers who have an iPhone and a Mac and an iCloud and their AirPods, they struggle to shift. They're so embedded in the system, embedded in the Apple frame of mind, that switching is not something that they're willing to do. But that walled garden and that stickiness of those customers is so hard to put a value on. What value do we give it? And even in the case of brands, it can be really hard to actually assign a value because it is an intangible asset. If we look at LVMH again, the brands is a key asset for LVMH. The word brand is mentioned 66 times in LVMH's most recent 70-page annual report. And on the balance sheet, LVMH does give a value of its brand. It actually gives the value of its brand at 25 billion euros, which is about 20% of the whole of the company's net assets. It's really high, but that is a self-identified intangible value. There are other ways that we can use financial metrics to sort of assess an economic moat. High gross margins, for example, and low churn if it's a subscription business. But generally, this intangible thing, this protective moat, is quite hard to assess. And gaining an understanding of the company and how it operates and who its customers are is really key to understanding if that protective moat exists. And we can see at LVMH how all of those things, that the high quality financial metrics, the protective moat, the strength of its management, and the fact it's got a really solid business model, how they all interact to generate some pretty magnificent results for shareholders. So this chart shows that in 2014, the company announced it was 6 billion euros of revenue, and it made about 30 billion euros it was 30 billion euros of revenue, about 6 billion euros of net profit off those revenues. A net margin of about 20%, which is already quite high. But more significantly, those profits generated almost 5 billion euros of net cash, which was equivalent to a net cash conversion of 78%. The management reinvested a lot of that cash back into the business. And by 2018, revenues had risen to about 42 billion euros and net profits were 7 billion. By then, free cash flow conversion was almost 100%. The company, again, reinvested a lot of its cash back into the business. And you can really see in this chart how that reinvestment has compounded away to generate really impressive shareholder returns. Over 5 years, the share price is up 177%. And over 10 years, it's up 516%. Now, this slide feels like a nice place to leave the presentation, as I think it's a really good image of the compounding quality factor in action. So we've got just under 20 minutes left until the scheduled end of the session. So a nice amount of time to address some of the questions that you've been asking. Thanks for sending them in. And thank you, as I say, to the people who submitted questions beforehand, because it's given me a bit of time to actually really address one that's cropped up lots, which is the practicalities of implementing a quality strategy. So everyone has their own approach, but at Stockopedia, we really favour the use of screens to add at least a bit of systematic investing into the mix. For me, because I like to research companies, I'll use my screen just as a starting point. And then I'll add anything that looks promising to a watch list, which I'll monitor and when I have time to do deeper research into those stocks. But for investors who don't have the time or perhaps aren't confident enough to do their own deeper dive, it is possible to use a fully systematic approach where you set up a screen which ranks the stocks according to your desired metrics, and then you just pick the top ones. And this chart shows the performance of the Stockopedia quality rank over the last 10 years. Now, the top ranked quality stocks have grown 144% in the last 10 years compared to a pretty flat performance for the benchmark. And then there are two really important things to note if you're going to choose this fully systematic way of investing. And the first one is diversification. And you need to make sure that you are looking across multiple sectors. But with the quality factor, it's actually less important than the level of diversification needed in some other factor strategies. Some sectors do lend themselves naturally to being higher quality. So it's okay to maybe select from a slightly smaller pool of sectors than you would do for, say, a value strategy, but you still want to make sure that you are diversified across multiple sectors. And then the second thing to consider is rebalancing. So the performance chart is actually annually rebalanced, and you need to make sure that you are selling any stocks at the end of each year which no longer are the top ranked for your criteria. Now, the second question, which comes up a lot, is when to buy and when to sell. On the buying front, it is hard not to let some inkling of value analysis come into your thinking, and that is completely fair enough. But true compounding qualities, which just keep growing and producing impressive revenues to returns to their shareholders, they are few and far between. Identifying them does take a lot of research, so it's quite sensible to employ some sort of value analysis into your thinking as well. And add stocks to your watch list and set a target of when the valuation looks reasonable. Now, I've seen we've had a question in from Adam. Thank you for your question. How do you work out what is too pricey? That is very, very tricky, and especially with the compounding quality sector, because of those intangible assets. Because what is the value? What is the intrinsic value of those intangible assets? Now, for me personally, it's okay to acknowledge that those intangible assets can contribute quite a high value. I think we've seen in the last 10 years with some of the tech stocks, it's really been those intangible assets that have meant they've been able to just keep growing year after year after year. So having those slightly higher valuations is, to me, okay. Now, what is slightly higher? I mean, I use price to earnings ratio, I use earnings yield, and I compare them to other stocks in the sector, but I also compare those rate metrics to the company's own history. And I think that's quite important. If you're looking at Apple and it's trading on 36 times forward earnings, that is obviously a very high multiple. But if over the last 5 years the stock has been trading at 45 times and it's been able to maintain that over the last 5 years, and at the moment it's slightly lower than that, that actually might be quite a good buying opportunity. But then back to that second part of that practical question, when to sell. Again, there are challenges, and back to Apple. I wrote a short article last week about my regret in selling Apple in 2021 when I was so sure it was approaching its peak, and 2 years later it's still growing. And that is the thing about compounding quality strategy. The ideal holding period is forever. In other words, don't sell. But of course, you do need to keep monitoring the situation. If the investment case changes fundamentally, then that's a reason to ditch your stocks from your portfolio. But compounding quality stocks shouldn't really be sold for their valuation or indeed what's happening in the wider market. Now I will stop sharing my presentation now because I haven't got any more slides, so I can be slightly bigger on the screen. Another question that came up pre-webinar, and obviously I realise that this has been quite international heavy because there are so many high quality international stocks. But the question that came up is actually about building a well-diversified quality portfolio in the UK. Now, for me, I think this is tricky. I think there are a handful of high quality stocks in the UK. I think there are a handful of extremely good stocks in the UK. Companies like Unilever, companies like Sage. But actually, if you look at their international peers, so for Unilever, an international comparator is Nestle, for Sage, it's the US tech giant Intuit, they tend to be slightly better. So for me, because investing in the US, there are lots of platforms which make it quite cheap and quite easy. IG, for example, which is the platform I use, is a good platform for investing in the US. I think, why not diversify by investing in international stocks? because there is that bit more quality in international markets. That they're bigger markets. They lend themselves to bigger companies which can compound and keep growing. But that doesn't mean that there aren't a lot of high quality stocks in the UK. We've seen Games Workshop over the last decade, which has been an absolutely phenomenal stock. It is a truly compounding quality company. Is size going to be an issue? What stage is it going to stumble? Is it going to hit its maximum limit? I don't know. And that's one of the things about the UK market. Stocks tend to get big enough. But actually the one in the UK which is the most exciting for me at the moment is RELX. It's got a really interesting exposure to AI in the same way that Adobe has, actually. So that could be quite a key driver of the continued growth at RELX. So yeah, to fully answer that question, I think it is possible to build a diversified portfolio of quality stocks in the UK. It might need rebalancing a bit more than international markets do, but for me personally, I just think, why wouldn't you invest overseas? Right, let's take a look at what else we've got. To what extent is company management a driver of value? That's a really interesting question. Obviously, I addressed slightly there the fact that management is important in quality companies. Having good management who are making the right decisions, you want to look for that. You want to be looking for company management that are making bad decisions, really, and that is a red flag. But it's also important to notice that, another Warren Buffett-ism, look for companies that can be run by an idiot, because one day they will be. Now, I mean, that's not to say that all companies will eventually be taken into the hands of a CEO who isn't very experienced or isn't very good. But it's a really interesting point that not relying on individuals is quite important. Like look beyond the management. But I do think that management can make a big difference. They can make sensible investment decisions. It's that reinvestment, it's that attitude to reinvestment, which is really key. Which actually leads on quite nicely to another question that we've had about the use of share buybacks. Obviously, share buybacks have been they're nice for investors, because when a company buys back and cancels its shares, private investors end up owning a higher proportion of the company in question. Next is quite a good user of the share buyback. While I think Next is a brilliant company, I do wonder to what extent share buybacks are a detriment to continued growth. I mean, if you look at Next's annual report, they always say they don't choose buybacks ahead of reinvestment in the business. But then if you look at a company like Amazon, which maybe isn't a compounding quality company, but it's certainly a high compounding company, they reinvest almost everything. And it's now an absolute giant of the retail industry. And I think that attitude to reinvestment is really important. And that's where management can make a real difference. What are they prioritizing? How much are they returning to shareholders by way of dividends? And how much are they returning to shareholders by way of reinvestment in the business? Slightly different vibe, this question, but one that I wanted to address because I think it's a really interesting question. So thank you for it. How do we know where we are in the market cycle? It's a really tricky one, and it's not one that I necessarily want to answer directly. So sorry, I can't give a really clear answer. But it is that not knowing where you are in the market cycle, to me, is really interesting, because that's why I like investing in quality companies. Because regardless of where you are in the market cycle, whether it is turbulence, whether it is a high growth time, if you can have faith that your company is a brilliant company, then you can have faith that it will continue to generate strong returns for you, regardless of what's going on elsewhere. And if there are periods of real turbulence, if there's something massive that happens in the market, like the COVID crash, if you have some cash in your portfolio, using those opportunities to top up your holdings in those high quality stocks is a good thing to do. Okay. What else do we have? A question about RELX. Just looking at the top there, would it not fail screen based on debt levels? Yes, it would. I'm pretty sure it isn't in that. It doesn't come out of that screen. Unfortunately, it does have high debt levels. It does actually have to pay quite a lot of interest on its debt. it's a real shame. It is a red flag for RELX, and that is kind of, I mean, it kind of reinforces the issue about investing in high quality in the UK. I mean, I'd say that's one of the UK's highest quality, but it does have that debt situation. Debt at RELX tends to come down in the second half of the year because it pays its dividend in the first half of the year. But yeah, it is still there and worth being wary of. Right. What percentage of your portfolio should be quality companies? Do we need a bit of growth, a bit of risk, a bit of value and dividends as well? Depending on your attitude. For me, I only have what I deem high quality companies in my portfolio, and they provide me with dividends because a lot of them, especially in the UK, are dividend payers. They also go through phases where they provide me with quite a lot of growth. LVMH is one of the strongest performers in my portfolio over the last 2 years. It's almost doubled, which, I mean, is quite frankly astounding for a company of its size. But yeah, there's definitely an argument as well for including other factors in your portfolio. But being aware of the different timeframes that those factors work over. The momentum factor really is more of a short-term thing. So that the companies which are being driven by the share price momentum, it's not going to continue forever, that factor. So keeping an eye on when the time is to sell those momentum-driven stocks is very important. Ed has written about that this week, so you can dig into that a little bit more. And value as well. The value strategy works because companies are valued less than the intrinsic value of the company, and once the market value matches the intrinsic value of the company, then it's no longer a value play. So it's a different mindset. So making sure you're aware of that is key if you want to use different factors. What else? The sectors that you hinted at being naturally compounding quality. Tech is one. Tech lends itself to extremely high gross and other and net profit margins, and they're very, very low fixed costs. So the tech sector is one that does lend itself to high returns on capital employed. To be honest, most sectors which have lower fixed costs, they do lend themselves more to the compounding quality. Companies which are more asset heavy, they are ones which maybe don't lend themselves so much to the compounding quality factor. Also, companies which are exposed to the cyclicality of the market, so the mining sector, financial sector. Naturally, if there is that cyclicality in the overall markets, it's impossible for them to dissociate from that. So they're less likely to really be those compounding quality companies. A lot of retailers, they are compounding. They can be compounding quality companies, especially ones with really strong brands, their own brands, rather than something like rather than a company like Tesco. So not that kind of retailer. A company which actually has its own brands, which can, with protected brands, that is that they can be strong compounding quality companies. Could screening for high quality and value together lead to even higher returns in the long term? The slides that I shared with you earlier actually showed that the pure ROCE, so pure quality, performed higher. But I will actually double check on Stockopedia. These are all things that you can check yourself on Stockopedia. I can share my screen so you can see where I'm going here. It's a little bit zoomed in, but So we can browse through the top stock ranks and we can see what has performed the best over different periods of time, and in different markets. So since inception, the VM rank has actually performed the best, but the QV rank is actually, I mean, it's grown, but it's actually lower than both the quality rank on its own and the value rank on its own. So that's quite interesting. I mean, that's not to say that past performance is any is a driver of future performance, but based on this, based on the history, the quality rank alone has actually performed better than a combination of the quality and the value rank, which is quite interesting, and is what was also shown when we looked at the high return on capital employed alone, compared to the high return on capital employed for stocks, which also had a low price to earnings multiple. Does your stock ranking take into account a lot of these factors? Yeah, so our stock ranking is driven by these factors. So all of the ranks, so we the quality, value, and momentum, and we have also got a growth rank as well. They're driven by the factors, and they're also driven by the metrics, those individual underlying metrics. So the quality rank in particular is driven by, it takes into account the return on capital employed, it takes into account sales growth, and it also takes into account other metrics which I haven't actually mentioned here, but you can still explore within Stockopedia, like the Petrosky F-score, which is a way of assessing ongoing performance of a share. Okay, I think we've pretty much covered everything. Have we got time for any more questions? Are there any more? Oh, one about the. There are still some really interesting questions. Ticket for Relics is REL. Banks. Banks are interesting for me. It's another sector that I'm not particularly comfortable with, but you can certainly set up a screen specifically for a bank, and I'm pretty sure we've got some already, which I'm pretty sure Roland has written some screens for banks. Obviously, banks have got a slightly different operating model, so I wouldn't use the same screen that Buffett screen that I shared with you earlier to screen for quality banks. There are some quality banks, and they can be an interesting. They can be a really interesting sector to invest in. But yeah, it does require a slightly different screening. I won't go into the full thing now because obviously we are on 7 o'clock. But I will try and include a banking screen. I'm sure we've got one in the post webinar notes. Stock screen for relative strength. Yeah, thank you, Andrew, and thank you, Lawrence, for responding to that. See, Vodafone is an interesting case. So I would deem Vodafone is not a high quality company, even before its magnificent debt issues started to happen. I just felt like Vodafone was not prioritizing the right type of investment. It's an income stock. It's a dividend stock, and when companies which are dividend income plays cut their dividend, the share price falls. So they don't. I would argue that they shouldn't have necessarily been paying those dividends if it comes at the cost of reinvestment in other areas. And I think Vodafone and BT are prime examples of that. They have not reinvested appropriately. I don't really understand how telecoms companies, especially in the UK, I mean, there are some in the US which are slightly better, but why they haven't thrived in the current times where we're all relying on such strong telecoms. Obviously, I'm doing a webinar to across the world. The world relies on telecoms now, but I wouldn't call them quality companies. And Vodafone is a stock that I don't love, apart from for its income. But on that is a slight negative note to end on. I'll try and quickly end on a positive note, on the fact that there is a lot of quality out there in the UK and internationally, and hopefully the screens and some of what we've talked about today can help you identify that quality. So thank you all so much for tuning in and for all of your questions. And we hope to see you back on another webinar in not too long. Keep your eyes peeled for any communications from us about upcoming webinars, and also keep getting in touch with us via the Discuss channel of the website. We love hearing from you on all of the stocks, all of the strategies that we're talking about at the moment. And we'll see you soon.